Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We've been coming to you live from TD Ameritrade's Link Conference in Orlando, Florida. Joining me for this segment where we talk about options and the registered investment advisor is Dominic Paoloni. He's the CIO and founder of IPS Strategic Capital and the Where's Waldo of the options industry, Mr. Eric Kopp from the Options Industry Council. Thank you both for joining me. And I call you Where's Waldo because we seem to meet up randomly, whether it's in New York, Philadelphia, Florida, Chicago. But let's talk about overall trends that we saw from inside ETFs last week and the Link Conference this week, because there's some big themes here.
There are, Jill. And, again, we talked about Cerulli, my quantitative study, when we were at the Inside ETF conference. I have my colleague Dominic Paoloni here, who also sits on a leadership council that we have at the OIC, which is really kind of, I like to refer to it as our field officers, option-centric advisors that are really out there kind of talking about, the benefits of using options with clients. And TD surely is an option-centric firm. I mean, you not only see it with the technology, but also just with the sub-advised managers that are here in the exhibit hall.
Right, and we saw that a lot with at the Inside ETF conference, using option strategies within the ETFs, RIAs adopting it more within their strategy. So Dominic, I want to get your inside look into this. How important are option strategies to your business?
100% important. I moved to TD Ameritrade because of their focus on options. And it just gives us the edge as an advisor and now as a fund, a great platform and a great group of people.
I want to ask you about your fund because it's a long volatility fund in a short vol world.
Yes, it is.
How is that playing out?
Well, actually really well, even though being long vol in this market is very, very difficult. Mm-hmm. So I need to sleep at night. When my head hits the pillow, I want to know if we have a crash and North Korea blows up the world, then my clients will be fine because we're actually long volatility in a short vol world. It's interesting because I think that you see a behavioral bias in the advisory community in that advisors chase what had the highest Sharpe ratio over the last 3 years. You look at what was popular in 2010, 2012, it was all tail risk funds, tail risk strategies. Now it's what? It's ETFs and short vol. Very crowded trade. And if I've learned anything in my 35 years in this business is if everybody's on one side, I want to be on the other side. So I can sleep at night knowing if this market really rips down and crashes, we're good.
All right, and let's talk about registered investment advisors and the use of options. We'll go back to the Cerulli Associates study that we spoke about last year. Do you continue to see more RIAs coming on board and sticking with options once they start incorporating them?
It's interesting. I think that's one of the themes, Jill, that we're seeing over the years that I've been at this conference, that more and more advisors who might have been a little intimidated coming by the OIC booth are now hearing a lot more, the fellas at TD, JJ and Snyder and Q and all those guys who have their commercials on CNBC. The advisors that are here, they hear from colleagues like Dominic, wow, clients are actually interested in hearing about whether it's a hedge strategy or an income strategy. So I think that once they start doing it maybe for themselves, then they feel more comfortable starting to talk to their clients about it. And again, you and I have talked about this. It's either they want to be their, say, own general contractor or, maybe farm it out, or they're going to be the do-it-yourselfer and manage their own positions.
Well, what's interesting is where do you go? Where do you hedge? Where do you get covariance? Debt? When you have the Fed rolling off their balance sheet, when you have China basically telling us they're going to stop buying bonds, when you have the president saying he's going to become protectionist, which is going to kick up inflation, you're going to really hedge your portfolio with any type of debt, whether it's 10 or 20-year debt. Diversification is not a hedge strategy. It's a diversified beta strategy. But what are you getting from debt? You're getting income, which is you're going to lose corpus because the principal on debt is going to go down as interest rates go up. Where do you go? The best place to go in the years I've worked with Eric is options. Options are the only investment vehicle in the world that you can build structural asymmetry. ETFs, stocks, equities, they're linear. Options are not linear. Options, because of something called the vol surface, not to get too technical, right, you can actually create asymmetrical trades, which create asymmetrical beta. So our goal is not to win on the upside. Mm-hmm. Our goal is to participate on the upside, but always win on the downside. And if we can structurally create asymmetry, we're going to win in the end.
All right. Well, thank you very much for both of your insights. And traders, thank you for spending the day with me at the Link Conference. I'm Jill Malandrino, Global